Hey everyone, welcome back. We're going to be diving into something today that really, I think, impacts all of us no matter what stage of life we're in. Retirement planning. We've got a great document here that a listener sent over, how to plan for retirement. And I have to say, it's packed with info. So our goal today is to really break it down and make sure that you walk away with the key takeaways and, feel informed and empowered, not overwhelmed. One of the things that really stood out to me reading through this document was how much emphasis it placed on starting early. I mean, we've all heard about compound interest and, the benefits of investing early, but seeing the numbers laid out like this really puts things into perspective. We're also going to dig into the reality of whether public pensions will actually be enough for us in the future and, explore a whole range of investment options that might surprise you. But before we get into all the details, I'm really curious to hear your perspective on this. Why is retirement planning so essential? The document talks about, freedom and maintaining your lifestyle, but it feels like there's even more to it than that, wouldn't you say?
Absolutely. It really goes beyond just the financial piece of it. It's more about, think of it as crafting that next chapter of your life. Retirement planning is about designing the life you want to live when you have more time and hopefully fewer obligations. It's about making sure you have the resources to pursue passions, travel, spend time with loved ones, or simply just enjoy the freedom to do whatever brings you joy. And you're right, the document doesn't shy away from the potential shortcomings of just relying solely on public pensions. Especially with, things like changing demographics and economic uncertainties, it's becoming increasingly crucial to view public pensions as more of a safety net, a foundation, but not necessarily the whole structure of your retirement plan.
Right. It makes it super clear why we can't just sit back and assume those pensions are going to take care of everything. So how can we proactively build a stronger foundation with private retirement plans? The document mentions this concept of the 3 pillars of retirement planning. Can you break that down for us?
Yeah, of course. It's a really helpful framework for understanding, the different components of a comprehensive retirement plan. You can think of it like this. Public pensions are your base. Right? They provide that basic level of income. Then you have your private retirement plans, things like your 401ks and IRAs, and they act kind of like the walls, offering more control and potentially higher returns. But then lastly, you have personal savings and investments, and those form the roof, allowing you to really customize your plan based on your own risk tolerance and financial goals.
That's a great way to visualize it, but I think for some people, even building that roof of personal savings and investments can feel intimidating. Where's a good place to start if you're feeling overwhelmed by all the choices?
You're right. It can be daunting. I would say a good first step is to really honestly assess your current financial situation and then project those future needs. Consider your current lifestyle, factor in potential healthcare costs, inflation, and really think about the activities and experiences you want to enjoy in retirement. This will give you a clear target to aim for. Okay,
so we're talking about being proactive and taking control here. The document points out that public pensions might not be enough in the future. What's going on there?
Public pensions, while they are designed to provide that safety net, they do face some challenges. Factors like increasing life expectancy and potential economic downturns, they can strain these systems. And they often have minimum contribution periods. And the benefits are typically tied to your earnings history and how long you've actually contributed.
So if someone is listening and they're thinking, okay, I'm diligently contributing to my public pension, but is it really going to be enough? What action can they take based on this information?
Well, that's where online pension calculators can be super helpful. Many countries offer tools online that allow you to project that potential pension income based on your current contributions and your projected retirement age. And this gives you a more realistic picture of what to expect, and it helps you figure out if you need to consider additional saving strategies.
That makes a lot of sense. So knowing that relying solely on those public pensions might not cut it. Let's dive into those private retirement plans, those walls of our retirement house. The document lists a whole bunch of options. 401ks, IRAs, annuities. A lot of people, I think, feel overwhelmed by the choices. What factors should the listener prioritize when making this decision?
You hit the nail on the head. It's easy to get lost in all the jargon, for sure. But here's what you should focus on. First, understand the tax advantages of each plan. Some offer tax deductions on contributions, while others provide tax-free growth on your investments. Second, you want to consider that level of control and flexibility that each plan offers. Do you want to choose your own investments, or do you prefer a more hands-off approach? And then finally, and this is really crucial, analyze the fees associated with each plan. High fees can really eat into your returns over time.
That's such a good point. I hadn't thought about how fees could impact things in the long run. So it sounds like choosing a private retirement plan is a pretty big decision. Lots of factors to consider.
It is. And don't feel like you have to navigate this alone. Seeking guidance from a financial advisor can be incredibly helpful, especially if you're new to investing or feel unsure about the best options for your situation. Absolutely. A good advisor can really help you sort through all the details and, come up with a plan that's right for you.
Okay, so we've talked about public pensions and private retirement plans, the foundation and the walls of our retirement plan. Now let's move on to that roof. Personal savings and investments. This is where it feels like we really get to take the reins and kind of, customize our retirement future.
Yeah, for sure. This is where you get to be the architect of your own financial destiny.
I love that. So the document lists a whole range of investment options. It's kind of amazing to see the variety that's out there. We've got mutual funds, stocks, real estate, bonds, even a mention of that high-risk world of cryptocurrency. It seems like there's something for every personality type.
There really is. And that's the beauty of it. You can tailor your investment strategy to your risk tolerance, financial goals, even your own personal interests.
So let's break down some of these options. What are the key differences between, say, stocks and bonds?
Okay, well, stocks represent ownership in a company. So when you buy a stock, you're essentially buying a small piece of that company. Stocks tend to be more volatile than bonds, meaning their value can fluctuate more dramatically in the short term, but they also have the potential for higher returns over the long run.
So if someone is comfortable with a bit more risk and they have a longer time horizon, stocks might be a good fit.
Exactly. Younger investors, for instance, who have, decades before retirement, might be more inclined to invest a larger portion of their portfolio in stocks. They have more time to ride out those market fluctuations and benefit from the potential growth.
Makes sense. So what about bonds? The document mentions that they're generally considered less risky.
Right. Bonds are essentially loans that you make to governments or corporations. They typically offer a fixed interest rate and a maturity date when you'll get your principal back. Bonds tend to be less volatile than stocks, making them a good option for investors who are seeking stability in income.
It sounds like bonds might be a good choice for someone closer to retirement who's maybe looking to preserve their capital and generate a steady stream of income.
Precisely. As you approach retirement, shifting a larger portion of your portfolio to bonds can help you reduce your overall risk exposure.
Okay, and then there's real estate. That's kind of a whole different ballgame, isn't it? The document highlights the potential for rental income, but it also mentions that it comes with its own set of challenges.
It does. Real estate can be a great investment, but it's important to understand those complexities that come with it. Requires significant capital, ongoing maintenance, and, really having a good understanding of the local market. It's not as liquid as stocks or bonds, meaning it can be harder to sell quickly if you need to.
So it sounds like real estate is more of a hands-on investment that requires, careful consideration and research.
Absolutely. It's not for everyone, but it can be a valuable addition to a diversified portfolio.
And what about mutual funds? Those seem like a good option for people who want to diversify, but maybe they don't have the time or expertise to pick individual stocks and bonds.
Yeah, mutual funds are a fantastic way to achieve diversification. They pool money from multiple investors to invest in a basket of assets, like stocks or bonds, or a combination of both. And this helps to spread your risk across multiple holdings, which can potentially reduce the impact of any single investment that performs poorly.
So it's like having a professional manager handle your investments for you, but with that added benefit of diversification.
Exactly. There are literally thousands of mutual funds out there, each with its own investment strategy and risk profile. So it's still important to do your research and choose funds that align with your goals.
The document also mentions cryptocurrencies, but it cautions about their high-risk nature. What's your take on crypto as a retirement investment?
Crypto is definitely the wild card in the investment world. It's a newer asset class, and it's highly volatile. And while some investors have seen those incredible returns, others have experienced, significant losses. So it's crucial to approach crypto with extreme caution and really only invest what you can afford to lose.
It sounds like crypto is more speculative than like a core retirement investment at this point.
I would agree with that assessment. It's important to focus on building a solid foundation for your retirement plan, with more established asset classes like stocks, bonds, and potentially real estate.
Okay, so we've covered a lot of ground here in terms of investment options, but regardless of which path you choose, the document really hammers home this idea of starting early. Why is that so crucial?
That's where the magic of compound interest comes in. And let me tell you, it's not just a financial concept. It's like witnessing a snowball effect in action.
Give us an example. Make it real for us.
Okay, imagine this. You're 25 years old, just starting your career, and you decide to invest $50 a week. Now, that might not seem like a lot, especially when you're first starting out. But over 40 years, with an average annual return of, let's say, 7%, that small, consistent investment could grow to over $500,000. That's the power of time and compound interest working together.
Wow. That's incredible. I think that example really drives home why starting early, even with small amounts, can make such a huge difference in the long run.
Exactly. And even if you're not in your 20s anymore, it's never too late to start. The key is to take action now and make those consistent contributions, no matter how small. Remember, time is your greatest ally when it comes to building wealth.
Yeah, it's like that saying, the best time to plant a tree was 20 years ago. The second best time is today. It really applies here.
I couldn't agree more. Even if you feel like you're starting late, taking those first steps can make a huge difference down the road.
Okay, so we've explored those 3 pillars, we dug into some different investment options, and we saw the incredible power of compound interest. That's a lot to digest. Is there anything in the document about specific strategies for different age groups?
Absolutely. The document does a nice job of breaking down advice based on where you are in life.
So let's start with, say, those who are just beginning their careers, maybe in their 20s or early 30s. What should their focus be?
For younger folks, the biggest advantage is time. They have decades ahead of them to let that compound interest really work its magic. This is the perfect time to embrace a bit more risk, focusing on growth-oriented investments like stocks. It's also a great time to establish good financial habits, like creating a budget, minimizing debt, and maybe even automating regular contributions to those retirement accounts.
So for younger investors, it's about taking advantage of that long runway and not being afraid to ride out some of the market's ups and downs.
Exactly. Think of it like planting those seeds early and watching them grow over time.
What about those who are a bit further along in their careers, maybe in their 40s and 50s? What shifts should they be considering?
Well, as you move into your peak earning years, the focus kind of starts to shift towards balancing growth with preservation. You've hopefully built a solid foundation by this point, but now it's about protecting those gains while still allowing for continued growth. Diversifying your portfolio becomes even more crucial at this stage, and you might consider gradually shifting a larger portion of your investments towards more conservative options, like bonds.
So it's kind of like finding that sweet spot between, keeping your foot on the gas pedal, but starting to tap the brakes a little bit.
That's a great analogy. It's about being mindful of your timeline and adjusting your strategy accordingly.
And what about those nearing retirement, maybe in their 60s or even later? What are the key priorities at that stage?
Well, as retirement gets closer, the focus shifts even more towards preservation and generating income. Protecting those assets that you've accumulated becomes really important, and you want to make sure your investments are aligned with both your short-term and long-term income needs. This might involve creating a withdrawal strategy, exploring annuities for guaranteed income, and minimizing that exposure to market volatility.
So it's like shifting gears from building that nest egg to ensuring it sustains you comfortably throughout retirement.
Exactly. It's about transitioning from accumulation to distribution and making sure that your money lasts as long as you need it.
This has been so insightful. We've gone from, potentially feeling overwhelmed by this topic to having a much clearer understanding of all the key elements of planning for retirement. One of the things that really stands out to me is how personalized this whole process can be. It's not about following a one-size-fits-all approach. It's about creating a plan that works for your individual circumstances, your risk tolerance, and your own unique financial goals.
I completely agree. It's about taking ownership of your financial future and making choices that empower you to live the life you want in retirement.
So well said. Before we wrap up, is there any final thought you'd like to leave our listeners with? Something to ponder as they continue on their retirement planning journey?
You know what I find most inspiring about this whole topic is that it's really never too late to start. Even if you haven't been actively planning, taking those first steps today can make a world of difference. Remember, it's about progress, not perfection. Every decision you make, every contribution you save, is a step closer to creating the retirement you envision.
That's such an encouraging message. It's about taking control, making those informed choices, and not letting fear or procrastination hold us back. So to our listeners out there, remember, planning for retirement doesn't have to be daunting. It can be an exciting journey of envisioning your future and taking those steps to make it a reality. You have the power to shape your tomorrow. and we're here to support you every step of the way. And that wraps up our deep dive into retirement planning. We hope you found this conversation helpful and motivating. Remember, the future is yours to create, and it all starts with taking that first step today